Good Wednesday afternoon, everybody. Glad you could be with us again today. We are live and it is Fed Minute Day. Not as big, not the same as a Fed decision, but we are going to get the minutes, which really details out the entire conversation that they had in their decision making. We know there's one of the Fed heads that did not want 50 basis points, only wanted 25, but we're going to see what they said and what their concerns are moving forward. Is it still really just all about employment? Do they think that the inflation battle has been won? Because recently we've seen, some data, we've seen the economy picking up here, which isn't necessarily a bad thing, but that certainly is going to, quash any hopes of a rapid decline in interest rates. But all that being said, boy, this market is resilient, isn't it? Let's take a look here. We've got S&Ps up right now about 27 points or so. High of the day was just about 10 points higher or so. So we're not far off from the high of the day. Excuse me here. Lots of big movers today. And one thing I want to point out that I just noticed in Microsoft, there was a massive out of the money call buy earlier today out in March. So let's take a look at those. Those are these 460 calls out in March. So those were purchased, let's see, above the ask. Okay, and those were all purchased at an average price of about $13.25, $13.30. So really not so far off from where they are right now. Okay, but that was an opening position of these call options being bought. Can everybody hear me okay? Can everybody hear and see me okay? Oh, TLT, we might look at something live here, guys. TLT is flashing on my alert list here, as you can see, and I'll show you guys why I have TLT on my alert list. And that is because we are right down now to the 200-day moving average. Remember what TLT is. We've talked about this before, but TLT is an ETF that replicates the 20-year treasury. Okay, so we talk about this again all the time. Rates and bond prices move inversely to one another. So if we see TLT coming down, that means these bond prices are coming down, rates are moving higher. Rates are moving higher. Now we may get a little bit more hint in an hour from now when those Fed minutes come out, okay? But right now we're seeing the 10-year, let me pull that up for you. Wow, the 10-year, it's up about 3 basis points today. I'm going to bring in a chart for you here to show you what the 10-year is looking like. It's now at 406, actually almost 407 now. Okay, and look at this move that we have seen since the Fed cut rates. Okay, here's where we were back just about a month ago, right around 360 or so, 365 level. They cut rates right here back on, I believe it was the 17th. And it's been nothing but a straight shot up. Okay, and that is because we have seen really a lot of good economic data, a lot of strength in economic data. Now, where can this 10-year go? Well, honestly, there's not a heck of a lot of resistance till we get maybe to the 420 level. And it is, pretty surprising to me that we have seen the market really hold in here and, still trade at all-time highs as we've seen this big increase in the 10-year. Now, personally, I think that we have seen too fast of a rise in rates way too quickly. That is why I'm looking for a retreat in rates and for bond prices to start going up. Bond prices go up, rates come down. So that is why I'm looking at this support here, this really big 200-day support here in TLT. So something else we need to look at, which we're going to dive into this soon, is look where implied volatility is in TLT. Does everybody see that? Hey Zora, how you doing? Does everybody see where implied vol is in TLT? Really, really expensive. Okay? Now, ordinarily I'd say, okay, when we see implied volatility like that, we want to have a credit spread. We want to sell premium. The problem with an option or an ETF like this in TLT is options are not that expensive to begin with. So it's real hard to put on a bullish position like selling a put spread in TLT because there's just not a lot of credit to be had, even with this increase in implied volatility. So one type of strategy I'd be looking at, okay, that would at least not get me short volatility, but have me in a neutral position. So if vol doesn't come down, it's not going to hurt me. Or if vol does come down, it's not going to hurt me. And it just gives me a long delta position. Remember yesterday, I think it was with our MPC, we were talking about combining a long delta and a short Vega position. Okay, one thing we could do that mitigates Vega risk is to potentially put on a butterfly spread. A butterfly is an equal amount of long and short options, and we can do this where we would have a long delta position. So we might look at something like, and I'm not going to be putting a signal out right now or anything like that, but we might be looking at that when we get finished. Yes, Zora, add TLT to your watch list. Okay, that would be the kind of position that we're looking at. Now that we've kind of touched on volatility and Vega, I want to continue from where we were yesterday, okay, and talk about how implied volatility and Vega impacts an options price, and also why we can see a big difference between near-term volatility and further out volatility, specifically the Vega component. So let me blow this up right here. Everybody see this on the screen? And let me put up a different chart than TLT. Let's put up something that maybe is a little bit more volatile, and let's look at, what do you guys think? Somebody give me a recommendation here. Give me a suggestion. What price, what stock do you want me to put up here so we can look at implied volatility? Happy to go with any of your suggestions here. All right, there's a couple. Let's take a look here. NVIDIA, Tesla, let's see. Okay, you know what? This is pretty good. Let's take a look at this here. Here's NVIDIA. Okay, now this is the implied volatility 1 year. Okay, and what we typically, when I say typically, probably 99% of the time use for our purposes is this IV30. Okay, what that is showing us is implied volatility projection 30 days out, okay, based on where it's been. Now, there are different time frames you can use besides 30. In fact, up here, you can see this charting software allows me to use 60, 90, 120, all the way up to 360. Why do you guys think that we pretty much only use 30-day? Okay, and I think we touched on this yesterday, but why do we just use 30-day? Okay, yeah, that's because probably 95% of the positions that we put on are positions that expire pretty short term, within 30 days. Exactly, Don, Robert, exactly. So we want to get the most relevant data to what we are trading. Okay, Zora, I certainly can, but I'm not sure that they have a real strong correlation to one another. What I'm going to look at is Vega and implied volatility, but not necessarily the VIX. Okay, the correlation of TLT and VIX, we can look at it, but that's really inconsequential. Okay, so here's our range for IV30. What do you think happens if we use a longer time frame? Whether we go out 60, 90, 120, what do you think is going to happen to the shape of this IV curve? I'm sorry, I just sketched over it, but what do you think is going to happen? Yeah, Robert, very good. And Oscar, thank you. Yeah, everybody smash that like button. Really help us out here. Smash that like button. Yes, we are going to see, Gilbert, you got it also, we will see something called smoothing. And if you think of it, kind of put it into just, normal kind of processing of data, the more data you have for anything, right, the less outliers you're going to have, right? The flatter or smoother we're going to see. So let me put that up on the board here. Let's do a comparison between the 30-day that we have up here, and I'll put up 120. Okay, can everybody see that? Same exact movements and same shape, but you don't see as big of a variance, right? It has flattened out quite a bit. And if I add in 360, same thing. And that's because, again, the more data you have for anything, the less outliers you're going to have. The flatter, the smoother that data is going to be. Okay, so if we were trading longer term positions, like let's say that we were trading 60-day positions rather than 30-day, I would use IV60. There's IV60 in the yellow compared to IV30 in the red. Okay? So we would use 60 if we were trading typically 6-month options. We would go to IV 180 and we would look at those implied volatilities like we do to determine whether an option is cheap, priced just right, or expensive based on that implied volatility. Okay? Does that make sense to everybody? Because then I'm going to take this a step further. Okay, great. Now, if we see this smoothing happening, okay, so options with a longer time frame, longer time to expiration, the implied volatilities don't move, don't swing as much as the shorter term options, okay, how does that affect option prices when we do see implied volatility moving? Because if we see implied volatility moving 2% for an option expiring in 30 days, that's not going to give us the same change in value of that option if we see an option expiring in 180 days also moving 2% volatility wise. And why is that? What's the missing link here? Okay, what is the missing link here? And this is what really pulls together. Bingo, Thomas. I wish I had a bell here to ring. Maybe I should do that from now on. Not theta, Oscar. Thomas got it with Vega. Robert got it with Vega. So let's see. Let's actually put a comparison on here and take a look. And we'll use it with NVIDIA options. Okay, we'll use it with NVIDIA options. And actually, before I do that, I want to point out, I see something coming across the tape here in SPX. Looks like there were just a huge amount of out of the money, actually in SPY, not in SPX, a huge amount of out of the money puts expiring today, 573. Look at the volume here today. Woo-hoo. They're definitely looking for some Fed movement in the market here from the Fed today. So these were bought. There were 212,000 of these bought. I'm trying to get a price here. These are the 573 puts. These things were bought at 26 cents. Ouch for right now. Whoever bought that. Ouch for right now. And the reason I bring this up, guys, is I want to show you guys what's trading, okay? But when you see other services or you see headlines or some of the gurus out there talking about unusual option activity, okay, that doesn't always mean that that is the direction of what is going to happen to that particular stock, or in this case, it's the SPY. You've got to take that with a grain of salt, because you don't know if whoever's buying these puts here, that could be an unusual option. So you look at it and say, oh my God, there's big put buyers in the SPX, in the SPY, got to get short here. That might just be a hedge against a long position, or maybe they're doing that as a hedge against other puts that they're selling. So I want you to be very, very careful if you ever follow the unusual option activity. It's not all it's cracked up to be. It's great information for what's trading. It's not always cracked up to what it's supposed to be, or what some people make it out to be. Okay, we're going to stick with NVIDIA here, and I'm going to shorten this up here so we can get all different expirations up on the board. Everybody should be able to see now NVIDIA options, and I'm going to focus in really just kind of at the money. Okay, so let's look at next week, October 18th, at the money option. And when I say option, when we're talking about volatility, Vega, doesn't matter if we're looking at a call or a put. It's not like Delta where there's going to be a huge discrepancy where if the call is a 70, the put's going to be 30. The Vega of an option, call or put at the same strike, same expiration, is going to be the same. So let's look at this at the money. So the 132 strike next week. And if we focus up here at this Vega column, we can see that Vega is 8.3. Does everybody see that? Okay, good. What that means is for every 1 percentage point that the implied volatility in NVIDIA moves, that option is going to change by 8.3 cents. Okay? So let's say the implied vol for next week's at the money, the 132 strike, changes by literally 2 percentage points. So right now, okay, we can see that it is 42.44. It's, fluctuating. We're live in the markets. It's 42.74 now, but we're seeing that the value of that option, the theoretical value, is $3.55. Now watch what happens, and this is one of the reasons why I love this platform that I use for pricing, for modeling. If I manually go in and change, so raise that implied volatility 2 points from that 42.70 to 44.70, okay? Watch what happens to the price of this option right here. Okay, let me go do that. It just went up about 16 cents. It went up from about 352 to 368. Does everybody see that? And it went up about 16 cents because the volatility risk, or vega, is roughly 8 cents per 1 percentage point move. Went up 2 points, 8 cents. There's the difference, 16 cents. Okay, great. Now, let's compare that to the at the money in NVIDIA going out 1 month. Okay, going out 1 month. So we'll look now at the November 15th. At the money, the 132 strike right here. And look at the vega. What do you notice here? What do you notice here? Compared to next week's at the money option. Exactly, it's about double, right? Next week's was about 8 cents per 1 percentage point move, and this is about twice as much. So that means if that implied volatility, okay, that implied volatility made the same 2 percentage point move, you are going to have a much, much greater impact in the price of this option. So let's do this right here. And you can see it went from $8.10 basically to $8.43. It went up by, lo and behold, roughly 33 cents. The vega times 2. So what that tells us is the implied volatility does not have to move as much in further out, longer dated options as in the shorter options to get the same effect. Does that make sense? Okay, now let's just compare one more, and then I'll bring it back to those implied volatility graphs that I showed you and the smoothing effect. What I'm actually doing here is proving out that smoothing effect for you. So now we'll go out to February, okay? So February, here's the at the money, the 132 at the money option. And that vega is now double what it was in November, or almost 4 times as much as what it was for next week's option. If I make that same 2 percentage point leap here, boy, that option went up roughly 65 cents, 64 cents or so. The impact, the further you go out in time, the impact is exponentially greater. So that takes us back to this chart right here, our implied volatility chart. It doesn't take as big of a move the further you go out to get the same impact. So thus, here's comparing the 30-day implied vol to the 90-day implied vol to the 180 and 360-day implied vol. So one of the reasons, and you may ask us, Scott, why don't we trade options that are further out in time, whether it's 3 months out, 6 months out, 9 months out? Why don't we trade those? As a floor trader, when I was trading on the floor, I used to love trading those because I could hedge them instantly. I could buy and sell like options, meaning duration-wise, and hedge that vega risk pretty easily. But for our purposes, I don't want to take on all that vega risk. I want to remove the vega risk and really concentrate on what I know best. And what I know best is what happens in the short term. That data of what just happened yesterday is most likely to happen again today. 2 days ago, not quite as much. 10 days ago, not quite as much, so on and so forth. So that's why I like to trade, and this is my personal preference. I would never dissuade anybody from trading further out options. There's absolutely profitable ways, strategies to trade those. But that is why we typically keep it close to the vest and don't go out in time. Does that kind of make sense? Because if you start to get some big moves in volatility, boy, it's going to impact those further out options. And if you're on the wrong side of the vol train, if you're on the wrong side of that vega train because you've just taken a position and you're long or shorted and it moves against you, okay, I want to eliminate that risk. I want to eliminate that risk. Okay. And just like that, we're towards the end of today's Market Minds. So you know what that all means. There we go, everybody. There we go. Let's see if can I get the music on here? No. Okay. Are we ready? Yes. Bobby, this is Sterling Live Vol. Okay. So it is not a cheap platform. I personally think it is the best platform out there for being able to model volatilities, which we trade a lot of. If you went to their website, I'll put a link to their website up here, and we don't get anything from it, but here is a link. It typically costs about $300 a month. As Prosper students, because we have so many of our students that actually use it, you can get it for about $100 a month. So it's still expensive, but I think it is so worthwhile. But you can try it out on your own. And there's the website. You can go there. You can get a free demo for, I don't know, they give you a week or 2 weeks free demo. Okay, and when you go there, they have a bunch of different options, no pun intended. The one that I use is called Sterling Vol Trader. It was built by the CBOE about 10, 12 years ago, and they sold it to this company, Sterling, 2-3 years ago. I love it. So there you go. All right, guys, let's spin the wheel. Here we go, guys. Here we go, winding down. I see a Gene or a Todd coming up. Todd Lindbergh. Are you still here, Todd? Are you still here? I'm hoping that you are. You know the drill. There you go. Send us an email with your mailing address and the size that you wear. Respin. Yeah, Anthony, maybe from now on we'll have that disclaimer, right? That if winner must be present to collect. Since we don't have that disclaimer, I can't do that yet. But if Todd's still not here, he's not going to collect. So he's got to reach out to us. Oh, there we go. Todd, you're here. Wonderful. Send us an email. All right, guys. 30 minutes to those Fed minutes that come out. Maybe we'll see a move in the market here. So keep an eye open for that. And then don't forget, we've got CPI and PPI coming up tomorrow and Friday. So we still could have a lot of activity this week. We will see you guys later. We'll see you tomorrow. Have a great day, everybody. Thank you.